Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. Alright, first of all, the US dollar index is heading a little higher, and as you can see on the day session, it has been able to have a somewhat of a bottoming pattern. As you guys can look closely, these are the type of patterns that you got to really watch out for. The dollar index's trading session isn't quite over yet, but at the same time, you have to look at this line right here, the red line. If it closes anywhere around the 79.90 area, chances are it's going to look like a doji harimi star. If it were to look like a doji harimi star, it looks very good from the dollar index's standpoint. I mean, even now, this looks like a bottoming hammer, but if we pull back a little, then you look at the macro picture, and that's a clear candlestick of a potential reversal in the marketplace. After a market has had a continuous downstream or downtrend and movement where the market's pivot, it continues going lower for a while. Eventually, it pulls back, and eventually it creates some sort of support or a base before heading higher. Now, where's my? And here's the thing about uptrends. They're not a perpetual ride upwards, but they actually look like there's something similar to this. A little goes a little up, a little pulls back a little bit, goes a little higher than off that, and then it goes back a little bit, and then goes up a little more. And it works the same way, vice versa. It goes down a little bit, okay, it goes up a little bit, but it never goes back to where it was previously. It just continues going lower. This is where the markets like to fool you a lot, and I had to learn this the hard way. But now that I know it, I can avoid a vast majority of the pitfalls that come while you're trading. In this case, we're still in an upwards trend. And this area, yes, it is also a double bottoming area as well. So we've got a double bottom right here, but you're also working with that 50-day moving average, which is a lot of help. Now, this coincides with another chart, which is the Euro-US dollar. The Euro-US dollar is directly paired to the US dollar index, and it's weighted at around 50% of the index. And basically, the US dollar index is what the dollar index, the UUP, is based on, which I don't really use that much because the dollar index trades 24 hours and the UUP only trades around 8 hours a day. But the Euro-US dollar has been able to go up a little bit, and it has had some trouble breaking above that 50-day moving average. As you guys can watch very closely, this, I believe it's the 50-day, but I could be wrong. Oh, okay. Yeah, it is the 50-day moving average. But, it's running into that 50-day moving average, and it's having a hard time breaking out of it. So chances are we're going to most likely pull back and head a little lower. And therefore, the US dollar index should get somewhat of a bid for that reasoning or that logic that goes into this. And since the Euro-Japanese yen is also coinciding the Euro-US dollar with a move into that that 50-day moving average, it wouldn't be surprising to see it pull back from the 50-day as well. So we're just going to watch this market very closely. And right now with the Euro-Japanese yen, it seems like a lot of shorts are being flushed out of the market before it wants to head a little lower. So we'll just wait and see. But this is still, we're looking at a multi-year downtrend. No matter which way you look at it, sometimes you might get a nice little bid, nice little rally. Perhaps a good precedence for this would be around from 100, 102. Okay, so all the way down here, 100, all the way up to 110. So, it wouldn't be surprising to see the markets have a nice little bounce up, and it continues to go higher a little bit. But again, I only see that going on for so long before the market has to pull back and eventually hit some resistance somewhere along the line. But here is the levels. 110, all right? It goes all the way up to 110, and it starts off from 101, so that's a 9-point move. So chances are, if we were going to base it off that, 98, 96, 97, a 9-point move would result in, anywhere from around 106. So 106 could be a reasonable target. Because you add 9 to 97 and you get 106. Okay, so again, I'm just trying to think this all in my head, and I'm still trying to talk at the same time. So obviously you're just adding 9 to 97 is 106, duh. But basically this could be a reasonable target. It could go all the way up to 106. Chances are it could pull back again. But we're still, asset management is still pulling out of, the Eurozone, no doubt about it. The rate at which it's doing that, not that much, not as much, but it's still going to do it. If it were me and I was managing a multi-billion-dollar portfolio, I would take the euro. I would take my euros, invest into the Japanese yen, and buy Japanese treasury bonds. That is by far the safest way, and it will lead to currency appreciation, a little bit of bond appreciation, and some bond yields. But, I mean, considering the position we're in, we really couldn't complain. I mean, either it's that or you leave your money in European Treasury bonds with the probability or the option, or more like not really a probability or the option, but the potential that these governments go default, and if they default, well, you're not going to get paid back if you're a bond investor in any of these European governments. So therefore, it's better to invest your money into the Japanese Treasury bond market, where at least the government might have record deficit spending, but at least they have a large base of credit to borrow from, because 95% of the population in Japan is willing to lend money, or lends money back to the Japanese government and buys Treasury bonds. So the not 95% of the population, but 95% of the Treasury bonds are owned by the Japanese population. Okay. Now the Dow Jones Industrial Average is a little bit of a different story. Based on what we saw with the US dollar index, if we had a nice little rally on the US dollar index off that support area based on the 50-day moving average and the Euro US dollar resistance area, chances are, since the dollar is going up, that's going to deflate the equity markets. But it's not just deflation that's going to have an impact on it. We're dealing with a multi-year channel area. This is, if it breaks out, it could lead to some serious upside. However, the downside to that is, from my experience at least, when you deal with a range, most of the time we pull back from the range. Only under certain circumstances will you ever break out of one. And it's really an if and or game here, because the options markets are pricing risk premiums at a much higher rate. In other words, you have to pay much more for a put option than a call option. So people are assuming that chances are the markets aren't going to be able to go much higher. Okay? So the options market are saying that, at least in the near future, over the course of 3 to 6 months. At least over my previous video, I already showed you the options chains. But the whole point here, options pricing is saying, okay, you know what, I want more money in return for hedging your risk. So right now, market participants believe, at least based on the pricing, that the markets are going to pull back. And if they pull back, it wouldn't be surprising to see us pull back to that 200-day moving average. I wouldn't be surprised at all, which would be the 12,000 area. Now that doesn't mean I'm going to be shorting the index ETFs or anything. I'm just looking for better opportunities, and the better opportunities are the weaker plays in the stock market. So you're looking for stocks that aren't performing as well, and those are the easier targets. And the weaker stocks tend to pull back with the macro. So if the Dow component pulls back, chances are the weaker companies will pull back by a factor of around 2 to 3, and that's really what I'm going after. But you'll figure that out later on in my video. As for silver, silver is in another trading range of its own, and this is another pattern. And again, this is the support, then the second support, and the third support, and this is the top end. We haven't reached the top end of the range yet, and we're already pulling back. The main reason why we're pulling back is, again, US dollar index strength. And chances are this trend could continue. If this were to continue, I wouldn't be surprised at all to see the silver market continue to pull back. And the same thing is gold, because gold and silver is both paired to the US dollar. Remember, it says XAG US dollar index, spot. So I'm talking about the spot silver and the gold spot market, which is the foreign exchange market, which is by far the least priced market because it has the highest amount of liquidity. More liquidity always implies more accuracy when it comes to pricing. Okay. Now moving on, the gold market has been able to bounce up a little bit, and has been able to break above that multi-year trend line from all the way July 2009 highs, all the way from the bottom right here. Gold is still in a multi-year uptrend. However, if anything major were to happen out of Greece, Italy, Spain, or Portugal, that would cause a shrinkage in currency. Why? Because it causes people to be fearful. Fear causes people to take their assets and allocate them, and basically it freezes up credit. You need to lend money to create credit, to create currency. If the money multiplier effect doesn't work, okay? And the main reason why it wouldn't work is because people aren't willing to lend. You need to lend for money to multiply. If it doesn't happen, currency immediately shrinks. And when you get a shrinkage of currency, what happens is you have less currency around to buy any commodity or asset. So what happens is commodities have to deflate. And commodities deflate in proportion to however much currency deflates. Not always, but you'll have an immediate immediate reaction to in the marketplace to it. Therefore, the way I see this is that if the U.S. dollar index, again, were to have a decent rally, which it could in the short term, chances are the gold market will pull back from this upper end of this channel right here. And it's also consolidating around that 200-day moving average, so you got to be really careful with this market, and it's not a good opportunity to buy. You want to wait a whole week above this break above the channel, and you want to just monitor it. Be careful, okay? Again, there are so many factors to consider going into this. It's not a very good opportunity at this point, and I'd rather you close your position and look for a better re-entry at some other point. It's never too late to trade, okay? Moving on, LinkedIn. LinkedIn has had trouble pulling back. I mean, it has had a couple days where it kind of slid to the side, but it's not really doing what I want it to. It's not pulling back. So therefore, I might lose half a percentage of my portfolio. Okay, fine. The main reason why I'm pulling back is not because it reached my risk threshold or my risk tolerance. I'm pulling back because it's not performing or behaving in a way that I anticipated. So I'm going to wait on LinkedIn, and instead I'm going to look for different opportunities, such as Research in Motion, which is a much weaker stock. Okay, it's already below, again, the 20, the 50, and the 100-day moving, the 200, the 50, and the 20-day moving average, and it broke down from this bear flag pattern. Break of the bear flag. Again, we have a single day session right below that 50-day moving average. This stock is definitely in a downward trend, and I think it's going to continue that based on their poor performance and, of course, their lack of exposure or their lack of dominance in the smartphone space. Sears Holding has also had a pretty significant pullback. I noted that it's starting to close below the day's open, and therefore I just started saying, hey, you know what, I'm just going to short this thing, or not really short this thing, but I think it's going to head lower. Alright, I'm already short, but I think it was going to head lower. Lo and behold, it already did that. It tried bouncing up a bit today. A lot of shorts got squeezed out. You know, that's why you can't have weak hands in this marketplace. You got to really know what you're doing. I didn't get squeezed out because I have a higher risk tolerance, as long as the trade behaves in a way that I anticipate it to. And right now, I think it's going to continue to pull back a bit. Volume is dropping, and remember, this stock likes to pull back whenever the volume is relatively low. So as long as the volume drops, that means shorts aren't covering as much because institutions are the main players. The only reason why you'd have a certain sudden surge in volume is if there was something wrong. You wouldn't get, and there's no way institutions would just come in and buy Sears Holding. What they're doing is a huge cover rally, and now that's abating a bit, the volume is dropping a bit. Because volume is continuing to drop, the stock price is also sinking as well. So again, I anticipate much more downside in Sears Holding, and that does it for me today. If you have any questions, leave a comment right below.